How you doing? Jamie Johnson here, and welcome to the Traders World Online Expo and the NoBSFX.com webinar, Current Positions for Top Forex Markets. What I'm going to do here is I'm going to put up the inevitable disclaimer, and while I do that, I'll give you a brief history of myself and what to expect in today's webinar. So here's the inevitable disclaimer, and basically says be responsible for your own actions, and past results do not guarantee futures results. Once again, I'm Jamie Johnson. I'm the president of NoBSFX.com, and I've been trading the financial markets for about 16, 17 years now. And I got into this business because Robert Miner of Dynamic Traders Group is my stepfather, so I learned to trade from him. And I was the chief trade strategist for Dynamic Traders Group for many years. I co-authored his futures and stock and ETF reports for many years, and then we started a Forex report for many years because I started trading that much more than stock and ETFs because I fell in love with its 24-hour high-volume nature. The natural progression of things was I broke away and just focused on Forex and started the NoBS Forex. NoBSFXTrading.com daily report and net trend video reports which I will talk about at the end of the webinar. I still do a lot of work with Robert, but now I just focus on Forex. What we're going to do today is talk about the positions of 5 of the markets that I look at in my reports. And while this is recorded October 15th, and while it's probably well past that, we're looking at the longer term positions of these markets, so it shouldn't matter too much. And I like these kinds of webinars because you can see if my analysis is correct or not. But let's go ahead and get started with the US dollar Canadian dollar cross. Before I do that, I just want to say thank you to Larry Jacobs for hosting this online expo. Let's go ahead and get started. So this is the US dollar Canadian dollar cross weekly chart that we're looking at here. I like this chart a lot because it demonstrates a lot of the things that we look at NoBSFXTrading.com in our analysis and our trade strategies. First of all, let's take a look at this January 2016 to May 2016 decline. It's unfolding in what we called an impulsive pattern or a non-overlapping pattern characteristic of a trend. Impulse waves usually unfold in the direction of the high degree time frame trend. So since this non-overlapping wave pattern compared to this overlapping wave pattern from the May 2016 low, since the January to May decline is non-overlapping characteristic of a trend, very likely the higher degree time frame trend is also bearish. Then the rally off the May low, I've already mentioned that it has an overlapping wave pattern sideways to up. This is characteristic of a correction or a counter trend, and counter trends unfold in the opposite direction of the higher degree time frame trend. In this case, the higher degree time frame trend should be bearish because of this bullish correction. Once this correction is complete off the May 2016 low, if in fact a corrective rally is unfolding, then we should have a resumption of the bear trend off the January high to below the May 2016 low. So one trade strategy that we look for in NoBSFXTrading.com is to get in a position, in this case a short position, at or near the end of a correction in the opposite direction of the correction to take advantage of a potential continuation of this strong bear trend off the January high. We also use oscillators to determine the trend direction of a certain time frame, and we also only look at trades in the direction of the high degree time frame oscillator position. So let me explain this. First of all, the DT oscillator is a proprietary oscillator for the DT software, the Dynamic Trader software, and it's at the bottom here. And for people that do not have the Dynamic Trader software, it's not a big deal because you can use any oscillator of your choosing, um, as long as the highs and lows of the market correlate relatively well with the oscillator setting that you're using. So in this case, the bullish and bearish reversals, or the highs and the lows of the oscillator, is correlating relatively well with the swing highs and lows of the market. So the top oscillator here is a slow stochastic. I have this on most of my charts in my reports, and any trading software out there has a slow stochastic. So as you can see, the oscillators are bearish. The slow lines are below the fast lines. This is a weekly momentum position that very likely a multi-week high should be near completion, if not already complete, as of the high of the week ending October 7th. Also, the high of the week ending October 7th is slightly below strong resistance. It's actually what we call a typical wave E price target of an ABCDE complex corrective rally, and it consists this resistance and target zone consists of three major resistance levels. One is the 100% alternate price projection of the wave A rally off the wave D low. The other is the 100% alternate price projection of the wave C rally off this wave D low. And the other strong resistance level is the 50% retracement of the January to May decline. So it's very wide range here, but it's resistance nonetheless. So any multi-week high in this market could be the potential completion of a corrective rally off the May 2016 low. Once a corrective high is complete, then the trend should be down for months, eventually taking out the May low. So very strong information here. I mentioned earlier that we only trade in the direction of the high degree time frame oscillator position. So this is a weekly time frame. So if you take trades in the low degree time frame daily chart with these oscillators bearish, only short positions should be considered in the low degree time frame daily chart. And all I want to mention here is if you trade in the low degree time frames, such as the 240, 60, or 15-minute chart, just our trade strategies dictate that you trade in the direction of the high degree time frame oscillator position. For instance, if the 240-minute oscillator is bearish, only short positions should be considered in the 60-minute time frame. If the 60-minute time frame is bullish, only long positions should be considered in the low degree time frame 15-minute chart. So in this chart, the oscillator is bearish. Short positions may be considered in the low degree time frame 240-minute chart. Right now in this market, we're just looking at the longer term time frames, the weekly and daily. A decline below the September 29th swing low would be the initial signal that a corrective rally is complete off the May low. So strong possibility the net trend for the rest of the year will be bearish, maybe much longer than the rest of the year. So let's take a look at the big dog here, the Euro US dollar cross. Everyone looks at the Euro US dollar cross if you're a Forex trader. It's not always the best time to trade this market, but it's always something to look at. Let's take a look at this Euro US dollar cross weekly chart. We're going to just talk about the long-term position and the potential net trend direction over the next several weeks, if not longer. So we're going to take a look at just a couple of weekly charts. We're going to take a look at this chart, which is a high-low, open-close bar weekly chart. Then we're going to look at closing date in the weekly chart. So first of all, this is way back to the May 2011 high, okay? Here's the July 2012 low. The rally off the July 2012 low had some corrective characteristics, sideways to up. Once the May 2014 high completed the corrective high, the bear trend continued. Now we have the May 2014, the March 2015 decline has characteristics of an impulse wave, non-overlapping wave pattern, characteristic of a trend wave. Trend is down. The rally at the March 2015 low has strong corrective characteristics. Once the corrective rally off the March 2015 low is complete, if not already complete, the strong bear trend of the Euro-US dollar cross should continue to below the March 2015 low. Okay, let's now zoom in to this corrective rally or potential corrective rally or rally off the March 2015 low with corrective characteristics. This is what we call a complex correction. And when and where a complex correction usually completes is hard to determine very often. Complex correction can unfold in an infinite amount of waves. So you have to look at different factors to see if a potential corrective rally or correction is complete. This is a complex correction because there's corrective patterns all over the place off the March 2015 low. There's corrective bull rallies and corrective bear declines. March 2015 low to August 2015 high. ABC corrective pattern. Decline from the August 2015 high down to the December 15th low. ABC corrective pattern. Rally from the December 2015 low to the May 2016 high, corrective pattern. So what's going on here? Complex correction. So what we can look at to help determine potentially when a corrective high is complete or if it's near completion is we can only really do this with weekly data in the Forex market. We can look at closing data. And the reason we can look at weekly closing data because the Forex market is a 24-hour market. That's why you can't look at closing data for daily 240, 60-minute data or time frames. But because the Forex markets close every week, we can look at closing data. And what looking at closing data does is it clears up the intraday noise of the market, and sometimes it helps you to determine what's going on. So let's go to closing data. And if we look at closing data, it looks like we may have a textbook ABC corrective rally complete off the March 2015 low. Let's go back up to regular data. The May 2016 high appears to have completed a potential ABCDE corrective rally off the December 2015 low. If this is the case, then the December 2015 low should eventually be taken out. Okay, this May 2016 potential wave E corrective high is the same corresponding high to this potential completion of an ABC corrective rally off the March 2015 low in closing data. So there's a strong possibility that the May 2016 high is the completion of a corrective rally off the March 2015 low. If this is the case, the net trend should be sideways to down for the rest of the year, if not for the next several months. Also, remember, this was recorded on October 15th, 2016, following this strong down week of the Euro-US dollar cross. There's some two very important dates here shown in thick horizontal lines. The June high and the June low. Guess what this big down week right here was? The low of the week ending June 24th. That was the Brexit announcement. A decline below the June low would further signal that the May high is a corrective high and that the net trend should be sideways to down for the next several months, if not longer, very likely for at least till the end of the year. And then a rally above the June high would signal that the decline off the May high should be corrective, and very likely the August high will be exceeded before a corrective rally off the March 2015 low is complete. So very strong dates here to pay attention to. Last week's down week, well, I can't say last week's because this is this was recorded on October 15th, but the down week ending October 14th was a bit of a surprise because this was looking corrective, but now that week's low is slightly above the June low, so it's a strong possibility the June low will be taken out and we'll have a bear trend for the rest of the year. But please keep in mind, in any multi-month bear trend, there will be multi-day and multi-week bull trends, so you'll be able to take positions probably on both sides of the market. It's just nice to look to see what the longer degree analysis and probable trend direction will be, and it's looking to be bearish for the rest of the year, if not several months. We also had, following the big down week ending October 14th, we had an weekly oscillator bearish reversal, a strong weekly momentum signal that the net trend should be sideways to down over the next few weeks. So you're watching this video now, it's probably at least the end of October, if not past that. So there's a strong possibility this June low has been taken out. Okay, but our outlook is the trend should be sideways to down at the least for the rest of the year, if not for several months. Now take a look at a market that a lot of people are looking at, which is the British pound US dollar cross because of the recent Brexit. And if you pay attention to this market, it's been in a strong bear trend since the July 2014 high, if not much longer. And this bear trend continues because of the announcement. But you can see these declines, like the July 2014, the April 2015 decline, more impulsive than corrective, characteristic of a trend, followed by corrective rallies. Once the corrective rallies are complete, the bear trend continues. Remember, this is recorded mid-October, excuse me, mid-October, October 15th to be exact. So this big down week right here, the week ending June 24th, is a result of the Brexit announcement. And this other big down week here that confirmed the rally off the July low as corrective. This is a result of, I believe it was a British economic report. And while some people may think that this strong bear trend will immediately continue, that may not be the case. There's a couple factors that are signaling that it may not be the case, or something to look out for anyway. Weekly momentum is bear oversold. Both the fast and slow lines are in the lower half of the the lower 25% of the oscillator range. This is a momentum signal that a multi-week low should be near, or the bear trend may be slowing down, and a multi-week low is probably near, if not already complete. We have a little inside week since that big down week. This is the week ending October 14th. So if we put a line above the week prior to the inside week, if we get a rally above the high of the week ending October 7th, this will probably be at least a temporary reversal from this bear trend. A decline below the October low will show a lot of weakness, and this bear trend may continue pretty strong. But weekly momentum is showing that a multi-week low should be near completion, if not already complete. Not much more to show you in the daily chart. I'll just put the 240-minute chart up for a second off this September 6th high. It's looking like a potential 5-wave decline is complete off the September 6th high. That would put October 7th in the position to be a multi-week wave 5 low. But because of this just being a spike down, I think it was only a 5-minute spike down, the result of that news event, this pattern is not as strong as it would usually be. But October 7th, a potential multi-week low. If this is a 5-wave decline complete as of the October 7th low, the typical price target for a corrective rally to a 5-wave decline is the 50% to 61.8% retracement resistance zone of the 5-wave decline. But as of right now, or when this market, or when this video is recorded, there's probably better markets to trade than the British pound, US dollar cross, or any other British pound cross for that matter, until there's some real strong pattern following the spike down. Let's take a look at this Australian dollar, US dollar cross market. It's kind of interesting. It has some conflicting signals between pattern and momentum. So I want to show you how we deal with that. This is a weekly chart we're looking at. And first of all, the 8 weekly momentum or oscillators, both the DT oscillator and the slow stochastic, have made bearish reversals. And this is a weekly momentum position that the net trend of the market over the next few weeks should be bearish. However, pattern is suggesting that the September low right here is a corrective low, and the reversal week low of the week ending October 14th. It's a bullish reversal week, which means the weekly close was above the open in the prior week's close. This is a reversal signal that the low of the week ending October 14th is a multi-week low, also potentially a corrective low. Remember, this video is recorded October 15th, so you'll know if this is the case or not already. First of all, let's talk about the low of the week ending September 16th, or actually the decline from the August 2016 high down to the September 2016 low. First of all, it has corrective characteristics. Sideways to down overlapping wave pattern. It's also in the typical time and price targets for a corrective low to the May 2016 to August 2016 rally. The typical price target for a corrective low is the 50% to 61.8% retracement zone of the previous rally, which is the May to August rally. Typical time target for a corrective low is the 38.2 to 61.8% time retracement zone of the May to August rally. So this is in the pattern, time, and price all suggest the September low should be a corrective low. If this is the case, the August high should be exceeded. Okay, and like I said, the reversal week low of the week ending October 14th is also a potential multi-week corrective low. This information is contradictory to the bearish weekly momentum, because if this is a corrective low, the net trend should be up, not down, for the next few weeks. So I'll teach you how to deal with this in a few moments. But the NoBSFXTrading.com trading rules dictate you can only consider trades in the direction of the high degree time frame. If the high degree time frame is weekly, then only short positions may be considered. They don't need to be taken, only considered, going down to the daily chart. So in other words, no long positions can be considered in this time frame with the NoBSFXTrading.com rules. So let's take a look here. Let me go ahead and make this bigger once again. So here's the September 13th low with a potential completion of an ABC corrective decline. That's the same low right here in the typical time and price targets for a corrective low I pointed out in the weekly chart. Also, here's the October 13th low. This is the same low as this reversal week low I showed here in the weekly chart. Probable corrective low, potential corrective low. The October 13th low also was slightly above the 78.6% retracement support level. This is a strong Fibonacci-based support level of the October 13th to September 29th rally. This rally has more impulsive than corrective characteristics. This decline has more corrective than impulsive characteristics. Strong possibility October 13th is a corrective low. And if this is the case, the September high should be exceeded. And if the September 13th low is a corrective low, the September 29th high should be exceeded, and if September 13th is a corrective low, the August 10th high should be exceeded. Let's take a look at daily oscillator or momentum. The 8 daily DT oscillator is bullish, so is the corresponding slow stochastic, and I even put a smoother daily oscillator setting, the 13 daily DT oscillator setting. This is also bullish. This is signaling the net trend should be sideways to up for the next few, if not several trading days. Strong possibility October 13th is a corrective low, and you probably already know if it is or not. Okay, with these oscillators bullish, long positions may be considered in the low degree time frame 240-minute chart. So, because of the bearish weekly oscillator, long positions may not be considered in the daily chart. Because of the bullish daily oscillators, long positions may be considered in the low degree time frame 240-minute chart. The 240-minute oscillators are bearish, but if there is a bullish reversal below the overbought zone and trade above a minor swing high, as long as this October 13th low is not taken out, be an ideal long trade setup for a potential rally lasting several trading days, if not weeks, very likely to above the September 29th high, if not to above the August 11th high. And you see, this is how we determine trade setup with NoBSFXTrading.com. Let's also take a look at another very interesting market, the US dollar Japanese yen cross. It also has some conflicting signals just like the Australian dollar US dollar cross had. This is a weekly chart we're looking at, and first of all, one thing we can all agree on is from the June 2015 high, this market's been in a strong bear trend. In our opinion, this strong bear trend is going to continue to at least below the June 2016 low. And let me talk about why. First of all, we have this June to July rally. Looks like it unfolded in a textbook ABC corrective rally. If the July high is a corrective high, this June low needs to be taken out to confirm the corrective rally. Then we have this July to August decline that has some impulsive characteristics, so the bias is the rally off the August low should be corrective. September high is a potential wave A of a corrective high, or the first wave up of a corrective high. The September low is a confirmed corrective low. 8 weekly DT oscillator is bullish. This is a momentum signal that the net trend should be sideways to up for at least the next 1 to 3 weeks. However, shorter-term pattern and resistance, mostly resistance, is warning this may not be the case, and we may have a corrective high off the August low at or near completion. And let me show you why in the daily chart. So here's that July potential wave C corrective high, right here shown in the weekly chart, but shown here in the daily chart. And it looks like we have an impulsive decline, 5-wave decline from the July high down to the August low. And I've already talked about the potential wave A and B of a potential corrective rally off the August low. Remember, weekly momentum is bullish. And let's just talk about daily momentum to get that out of the way for right now. The US dollar Japanese yen crosses in what we call a mixed daily momentum position. 13 daily oscillator is bearish, 8 daily DT oscillator is bullish in conflicting directions, which this really does not usually help determine the net trend direction over the next few trading days. So that doesn't really help the situation at all. One's been bullish, one's been bearish, and for the most part, not really a strong advance. However, let's look at resistance. The October 13th high is in strong resistance and narrow range resistance. If the September 2nd high is a wave A high and the September 27th low is a wave B low, October 13th, remember this is recorded October 15th, the October 13th high is in a narrow range, typical wave C price target, strong resistance nonetheless, which includes the 61.8% retracement of July to August decline, right here, and the 100% alternate price projection of the wave A rally off the wave B low. The 100% alternate price projection is you take this distance from the August 16th low to the September 2nd high, and you just add it to the distance from the September 27th low, okay, in pips. And you get this strong resistance area. This is the typical wave C price target. Also, this October 13th high was one daily bar before a strong time resistance, the 100% alternate time projection. It's the same as the alternate price projection, but in time with bars of the wave A rally off the wave B low. This is a typical wave C time target. So strong time and price resistance here. Strong possibility we may have a multi-week high at or near completion, potentially a wave C corrective high. If this is the case, this 8 daily DT oscillator should quickly make a bearish reversal, and the 8 weekly DT oscillator will probably make a bearish reversal without reaching the overbought zone. Something to look at here, and you probably know if this occurred already because this was recorded on October 15th. Well, that is the last market we're going to look at in today's webinar. Before we complete this webinar, I just want to take a few moments of your time and talk about the advisory reports that I offer at NoBSFXTrading.com. I first have a daily report that comes out Monday through Thursday and Saturday, and it looks at 8 markets: the Euro US dollar cross, the British pound US dollar cross, the Australian dollar US dollar cross, the US dollar Japanese yen cross, the US dollar Canadian dollar cross, US dollar Swiss franc cross, New Zealand dollar US dollar cross, and the British pound Japanese yen cross. And we look at 240 and 60-minute charts every day, talk about market position and general trade strategies. I also have a video report that comes out twice a week, and we look at the same markets that I just mentioned, but only twice a week. But we go from weekly down to daily, all the way down to 60-minute charts, and it's a video report. The daily report is a written report. Net Trend video report is a video report. Also, I have a 9-hour workshop that I offer on my website. A lot of information for a small price. But anyway, thank you for stopping by today. If you are interested in any of my report subscriptions, you can get more information at NoBSFX.com. And if you purchase any quarterly subscription of mine, either a quarterly subscription of the daily report or the Net Trend video report, or a combination of both, please email me, let me know you watched this webinar, and I'll give you an extra month of the subscription for free, okay? Here's the email address to use, jaime at nobsfxtrading.com. Also, use that email address if you have any questions whatsoever about what I offer and about what was in this webinar, okay? Once again, thank you so much for stopping by, and happy trading. Jaime Johnson, over and out.